You're back in business with me, Harsha Subramaniam. Let's now talk about a CRISIL report on quarterly earnings. Rahul Prithiani now joins us on this conversation on Bloomberg. Rahul, many thanks for joining in. What is the sense that you're getting out of revenue growth? Are you expecting quarterly growth to be tepid even for the first quarter?
Good morning, Harsha. Good morning to the viewers. This quarter too, again, we are expecting revenue growth to be around 5 to 6% for corporate India. Just to keep this in perspective, till Q1 of last year, we are growing at around 18% top line growth. Now that growth has kept on falling through the last year, and in Q4, actually it fell to nearly 4.4%. Now we are expecting that to almost flatten out in this quarter, primarily on account of the fact that going forward we are expecting some benefit to come in from the rupee, and many of the sectors now have developed fairly low bases compared to what they had last year.
Of the sectors that you're talking about, Rahul, which sectors are you placing your bets on that will perhaps see a marginal turnaround, if not dramatic?
For the sectors where we are expecting growth, I think it's the same set of sectors which have been performing well over the last few quarters. Again, we are expecting the rupee to benefit the IT and the pharmaceutical sectors in terms of their top line, though there are the benefits might be limited on account of maybe some wage hikes that you're likely to see in the Q1 for the IT sector. But other sectors like FMCG, power, tires, these are likely to benefit on account of softening of the commodity prices. So we are expecting healthy top line growth in some of these sectors.
But some of the issues that you talk about on areas like infrastructure, capital goods, from a policy perspective, from an overall macroeconomic environment perspective, things haven't really changed, Rahul. By when do you think for some of these sectors will turn the corner?
See, our expectation is that as we go during this year, we'll see some improvement in the performance of some of the investment-linked sectors. Investment climate continues to be fairly weak as of now. The recent moves by the government, some pre-election spending that we are likely to see in the third and the fourth quarter in the second half of the year is likely to pull up revenue growth for some of these sectors. But for Q1, we are expecting still very subdued to degrowth in even capital goods. We are looking at a minor degrowth, and construction sector we are expecting some growth, but it'll be very tepid at around 4% or so. And margins again will be flattish for some of these spaces. As you know, there is continual pressure, and interest costs again continue to hurt these sectors.
Are you expecting an improvement in margins though? Are you expecting profitability of some of these sectors to bump up in fiscal 14? May not be in the first quarter?
We are expecting more of a flattish kind of margins going forward for most of these sectors. As you know, in the last few quarters, now we are seeing almost flattening out. The declines that we've seen in the past, they may be over now. We are expecting more of a flattish kind of growth for most of these sectors. But yes, you will have some sectors where there will be continued pressure, where input costs continue to go up. Sectors like cement, sugar, airlines, where you're seeing the impact of the rupee because of the ATF prices moving up. So some of these sectors will continue to see some pressure. But by and large, most of the other sectors are almost flattening out. And in some sectors, as I discussed earlier, like power, as well as on the tires front, FMCG, some of these sectors, you will get the benefit of falling commodity prices globally. So overall, we are expecting more or less flattish kind of margins.
Rahul, we'll leave it there. Many thanks for joining us with your perspective. That's a view coming in from CRISIL. They're talking about how they're expecting tepid top-line growth in quarterly earnings this time around.